We are back, baby. Welcome back to Millionaire Mindcast, our Money Moves episode, where we love to dive in, give you your weekly edge on finance, real estate, tech, crypto, all the good stuff for the investing mindset. As always, we appreciate you guys tuning in each and every week. We are live, so as always, don't forget to drop your comments, questions, thoughts in the thread below. Mr. Breedwell, what it do? How we doing?
Doing great. How's everybody doing?
I mean, bro, that shirt is
swaggy, baby.
Look at that.
I have a client coming into the office, so I had to.
You had to get a little color, slick the hair back,
put a little bit of the wave. Yeah, baby, come on.
Well, I know you're happy with what we have been seeing in the markets. What went down with CPI today? So inflation dropped a lot more than expected.
I don't know. To me, it was right in line.
You were on that train for some time now. So we're going to talk about that. We got crypto legislation is heating up. Housing costs are still squeezing home buyers across America. AI keeps rewriting the rules of how we are looking at investing, how the markets are responding. We got a lot to unpack today. So. Yep. Why don't we start by, well, first and foremost, did you watch the McGregor fight this weekend?
Yeah, I blinked 3 times.
God.
I felt so bad for him. I was like, I don't know why you're doing this stupid-ass kick. You could see him, he winced when he landed. It looks like he tore something in his knee. I don't know what the official, if there is one out.
Tone, what was the official thing? Did he tear his ACL or something?
ACL or MCL.
Something like that. That was
what a shit way to go out.
Well, yeah, 5 years of ring rust. I was already expecting he was gonna struggle against Holloway, but the first 60 seconds to go in and throw a kick that you're not knocking him out like that. You're not doing any substantial damage to.
He was trying to be a showman.
Yeah, which is what he does, right? So
yeah, but it was already hyped. The people wanted to see you fight, man. I wanted to see you fight. You know what I said too? I think Holloway's going to – I told you.
Yeah.
I think Holloway's going to win just because that's how it's been going. But I wanted McGregor to win.
Yeah,
I just felt he was not going to win. I didn't know it was going to be like that. But, yeah, it was kind of wild.
Well, you know who did win is all the bookies in Vegas.
Oh, my gosh. And McGregor, what do you make?
Yeah, he made
30?
I want to say he made 19 mil in 60 seconds. And then all the endorsement deals, I think it was north of 30. But what a way to kind of – I don't think he's going to be able to come back from that. What a way to end your career after all that hype. Yeah. I don't think he's coming back. I don't see that happening.
I would – if anybody would do it, it'd be him.
Well, he'll come back and make a bag, but I don't know if that'll help his legacy whatsoever.
No legacy.
Yeah, well, we and FIFA World Cup's been great. We just finished watching the
Dude, that was a
France Spain spanking Spain spanking France here in the office. It was a great weekend of sports. I loved every aspect of it. I don't know if you guys love sports as much as I do, but
60 days ish till football, my friends, to all my football fans out there.
Baby,
I'm so excited. I'm so pumped. The waves don't even.
Yeah, you're flowing right now.
No, I'm flowing.
All right, so inflation print today was our kind of big headline that rocked the markets in a good way. So June CPI. Tone, can you see this, or I need to throw this up on the screen?
I told you guys.
Yeah, so we got June CPI inflation falls to 3.5%, which was below expectations at 3.8%. Core CPI fell to 2.6, below the 2.8. And month-over-month CPI inflation fell 40 basis points, the biggest monthly drop since May of 2020. So we saw –
it's a big deal.
That's a really big deal. I mean, especially after – I mean, the markets right now are saying we don't give a fuck about the Iran war anymore. They're so desensitized to it now, even crypto. I think what we see is, maybe market makers using some of those headlines to create some volatility and pull some people in or shake some people out of the market.
Correct.
But at the end of the day, the direction seems to be going up, up, up with stocks. Crypto seems to be holding pretty strong as well. We'll kind of unpack that a little bit and whether or not the 4-year cycle is still in play here. But what did the overall market response look like? You've been saying to me for a while now, like just as fast as this.
I said specifically the United States would flood the global markets with cheap oil while oil prices were down, and they did. And that same thing that make it go up, make it go down. But the same thing that makes it go up makes it go down. It's not. I don't know why people were overcomplicating it. The reason CPI numbers got so hot was because of energy prices. So when oil prices retracted themselves back down, it was pretty plain to see that was going to readjust that number down. Now, the one thing that I couldn't have predicted was the year-over-year number. I was thinking month-over-month was going to be good, and it was. But the year-over-year number, which I don't even think that was put in there, was down 70 basis points. 4.2% was the inflation rate last June. 3.5 is the inflation rate currently year-over-year in June. That's a huge, huge swing back. If we do that 2 more times, I don't know how, but we would hit the 2% goal that's been set by the Fed and mandated by the Fed, which would mean monetary supply can loosen back up.
So we saw today, rate hike probabilities drop almost 10%.
Oh, they're off the table. Yeah, they're off the table.
Which was a big deal. I mean, again, as a real estate investor, we were just talking. Ryan comes into the office. He's like, how much does it suck to be a real estate investor right now? I'm like, obviously it's my core tree trunk. It's what I continue to focus on. But it's been boring, not sexy. These are the times where actually I think it's a great time to accumulate real estate if you can, which we can talk a little bit more about that later in the show. But it hasn't been anywhere close to as exciting, specifically because the 10-year, because of where interest rates are at, where cap rate expansion, values have plateaued. We've just seen this weird kind of sentiment stick in the single family and the commercial real estate market. But in terms of the stock market,
past couple of weeks been choppy.
So just kind of recap that for us on what we've seen in the stock market, why, and then what's kind of with this recent CPI print, and we can talk about the Iran war with Donald Trump did just notify Congress, like, hey, we're at war again. I got another 60 days to do what he's going to do. They're talking about, I think CENTCOM today released new reports that between Navy and Air Force, they're kind of establishing and backing the blockade at the Strait of Hormuz. So we saw some relief today based on CPI, but are we going to see the next print spike again? And will we kind of be right where we're at, 60 days ago? Like, what are your thoughts on how the market absorbed today's and what is it looking at going forward?
My anticipation is that we're going to get I think oil was trading around $79, $80 a barrel last time I checked. I wouldn't be shocked if that trended up higher a little bit. But I think it'll quickly come back down. Because I just think the market's starting to figure out. This is very reminiscent of the Ukraine and Russia conflict that's still going on. That was early on. We had a lot of volatility in the market in the first couple months, and then people really figured out, it doesn't affect us as much. There's already alternative trade routes that are being established for the oil that are being done by Qatar and Saudi Arabia. So for those reasons, I'm not as concerned about it spiking inflation like it did in May. I think it's just going to be the market's going to digest it a lot quicker and faster and get past it. And it'll continue to do that, in my opinion, the longer that this goes out, because now headline is, okay, well, inflation is moving down. That means cuts cuts aren't on the table, but hikes are off. That means we're going to be kind of cruising here. So now people can kind of say, okay, I don't have to hold back maybe on this project
as much.
Yeah, exactly. So I think it still is going to push liquidity into the market, on not only on the real estate side, a little bit, but it'll get people off the sideline and back in the market as well. I was telling you while we were sitting down, I want to see a 76, 77 on that S&P and stop being stuck in that 74, 75 range like we have been.
Is cooling inflation a sign potentially that the economy is slowing in some capacity?
No.
So you don't see any scenario where consumers are feeling pinched, that the lower rungs of the economy are really being squeezed and kind of running out of steam. I know we've seen anybody that's owns asset in the stock market, wealthier getting richer, like that's very clear. But do you ever see or think about any of the scenarios of like that lower 2/3 tranche of the economy slowing in any capacity, and this print with some of these heightened tensions with oil and energy issues being maybe a little bit of a sign towards that narrative at all?
Not really. I think that the thing that's fun and always tends to happen is if the big guys, so larger companies, large cap, right now we can think of NVIDIA, in the healthcare space, Eli Lilly, in the car manufacturer space, Ford, GM. When those guys are doing good, the small guys tend to follow. They actually tend to do a little bit better on a return basis because they're more growth focused and have the size to grow faster. It's hard to grow $1 trillion company. It's easier to grow a $200 million company to $1 billion, right?
Yeah.
So to me, I don't see that narrative playing out. What I see is as inflation gets lower and the Fed gets closer and closer to its mandate, they'll say, okay, well, now we don't have to keep money supply so tight because we don't have runaway inflation data to support that. So now we can start letting people get money for a cheaper cost. I don't think it's going to be 0% again or anything like that. But if we go back maybe and look at what we're paying now, which is like 6.5, 7.1, somewhere in there for the APR nationally for a 30-year, I think we can see people getting 5.5 on bad to moderate credit and maybe high 4s on good credit, and then being able to refinance that maybe down the road to a lower rate on a 15 or a 20-year. So to me, that's good because I mentioned on the last podcast, we like mortgage-backed securities in the stock market, right? And we need mortgages to back those.
Yep.
So we need more mortgages out. They tend to be a backbone for the U.S. stock market, which is why you saw the U.S. stock market collapse so much in the 2008 financial crisis. Mortgage banks collapsed, mortgage market collapsed. You saw the U.S. stock market follow. So they really work in symbiocy. I'd like to see money supply increase because that'll not only get the real estate market kicking again, which I think is in a stall, it'll also bring more liquidity to the stock market and put value into names that I'm looking to have in. So like internet, satellite, phone, anything up in space, SpaceX, things like that, those will start getting some liquidity put towards them because they're higher beta asset classes right now.
Yeah, and we'll talk about SpaceX a little bit because obviously that stock and just the overall optics of it have been crazy over the last, call it month. And obviously it had its, shooting out of a rocket cannon to start. We've seen some pullbacks. I know we just picked up some at a little bit of a discount to try and get some exposure. We'll maybe talk a little bit about that because we have been asking people like, hey, when are you guys buying? What are your thoughts? So I want to get one we already did buy, so full disclosure there. But we'll talk about that here in a second. Before we wrap up on that, though, is energy the one variable that could drag inflation right back up? And I want to pull this quote and because we like to follow our boy Mohamed El-Erian, who's an awesome economist. He's great.
Good dude.
And he's overall usually pretty unbiased and just kind of reads data, right? He's a data dude. He said, I've been asked what happens to U.S. gas prices if, and it is a big if, international oil prices remain at current levels or move higher. The answer, we'll see regular retail gasoline rise back above $4 a gallon and diesel move back above $5 before the end of this month. So just as quickly as we saw it jump, and now we've seen just as quickly as it kind of shed off and retrace down, he's also saying that with some of these tensions still being stoked in the Middle East, and I mean, there was bombings going on today. I follow kind of all the accounts that
U.S. CENTCOM has been posting.
CENTCOM's great, right? They're giving real live updates on what our military is doing and how we're responding and all that kind of stuff, right? So it still seems like there's still plenty of activity going on in the Middle East. And the one thing that seems to be the linchpin for inflation is energy prices.
Mm-hmm. I would agree with that.
It impacts, obviously, internationally more than us domestically just because of our position. But at the end of the day, it still trickles over to us. So what are your thoughts around, whether or not inflation is solely tied right now to energy, or are there other variables that aren't getting as much attention that we still should be, keeping an eye on?
Yeah, I think oil is weighted too heavy for current metrics because we have, millions of electric car users that don't use any oil products at all, not even to maintain the car. That's a huge dip in the reliability on that. That still is an energy user, but that energy can be produced via solar or from a power plant with coal or something like that, right? So to me, that's not. I think it's important, but I would see it being retooled, and maybe it's like cost of power or something like that. But I don't see how if I go to the pump and I pay $96 to fill up my Tahoe, and then I go to the pump and I pay $120. I can't be riding on $24, ruining my life. That doesn't have as big of an impact as, oh hey, last month I was paying $160 in electricity and I'm paying $340.
Yeah,
like I'm paying hundreds of dollars more per month, and I'm forced to. And maybe in the summertime my bill goes up even higher than that. That's more realistic in how things work nowadays to me. But again, I can't. I think that's why it's important that Warsh is doing what he's doing right now, because I think he's going to do a heavy overhaul of how the Fed. He hired he brought on that group, the team, to look at that. Hey, we need to retool how we're looking at inflation data. We've said it for years. We said it in 2020. We said it for literally over 5 years. This feels like we're driving, looking in the rearview mirror, but driving forward and looking behind us, trying to figure out where we're going. It makes no sense. It just doesn't make sense. For how slow the economy used to move, that makes sense. For how fast data moves now, it does not make sense. It just doesn't.
Yeah. So this week we're looking at right now, obviously we saw June CPI inflation data came out today, Tuesday. Tomorrow we have, and here's the schedule, Tony, if you want to pull this up on the screen. So we got June CPI inflation data today, PPI inflation data tomorrow. We got retail sales data on Thursday, and then we got the manufacturing index on Thursday, inflation expectations from the Michigan Fed, and
I would say earnings is big this week.
And consumer sentiment data as well. And then, of course, we got 10% of the S&P 500 reporting earnings, which we saw some report today.
Yeah, J.P. Morgan, another bellwether that we love. Much better numbers than expected. I think we saw the craziest stock that I saw moving today that was a big boy is IBM, down 25%. At market close today, I was like, holy crap. 25% for a company that big.
That wasn't like 50 billion market cap or something like that wiped out?
Yeah, that's nuts.
Yeah.
Yeah, so that was pretty interesting to see. And then we saw, you mentioned Lucid Motors. There's some rumblings about them maybe filing BK, which obviously saw their stock tumble by 60-70% in a day, which is
that's wild.
Also wild. So that is the risk of speculating and owning individual stocks. If anybody wasn't aware, just as fast as it's there, it can just poof go away. So that's why you diversify. And then, like you mentioned, a little SpaceX action.
Yeah. So give us the update on SpaceX. Because I get a text from Ryan on, what was it, Saturday night?
Yeah, morning.
Something like that. Saturday night, Sunday morning. And he's like, I just bought us a little bit of SpaceX. And mind you, you've been saying the whole time, like, hey, we're going to find some exposure. We'll probably DCA multiple times. We'll find where we want to pick and choose. Ultimately, it'll probably be towards the end of the year when some of these unlocks happen. But we saw a major pullback in the stock. Like, what did you see, and why did you decide to get us some exposure to it?
I think that it was just where the price went down to. We're sub 150. So that's our entry point. I think we're below entry right now, but not by much for a stock like that. I think we're like 7 or 8% below as of market close today. It could change tomorrow, but as of market close today, about 7 or 8% below our entry point. That's a good spot. I don't see them. I hope I don't see them going too much lower than that, but they're a highly volatile stock, and right now their main thing they have is just a ton of cash. So cash heavy, results low, result light. People want to see more results. They want to see positive news. A lot of that pullback was because China had a successful landing of one of their rockets. I think they catch theirs on wires, though, so it's a little bit different. But that's a competitor. And so you can. That also shows the appetite to be in that space, no pun intended. So I think that it excited investors, but I think people just as quickly came to the realization of, oh, wow, but I should also be a little bit more cautious because this is uncharted territory. This is our new internet. We've never had publicly funded, because that's what it would be technically. If you're buying a stock and the stock price makes the company revenue, you're publicly funding these space programs while also they're getting funded privately by the U.S. government. It's wild. I would have never, like 20 years ago, if you told people this, they'd be like, oh yeah, no, that sounds great, but probably will never happen. Holy heck, we're freaking in it, dude. We have like a hybrid space program. It's like what's the Matthew McConaughey, Interstellar.
Oh, yep.
It's got like, without the darkness, it's got that vibe. You know, we're all funding this space program together to get to Mars or to put satellites in space to give people better and more high quality and faster internet and wherever they are in the world, give access to the world. And that has implications beyond just surfing social media. I mean, we're talking medicine, education to parts of the world that don't have it, bringing indigenous people from around the world that's hard to get them information that could be pertinent for them. What if they want to have a satellite phone so if somebody is really sick or they're having an outbreak, they can call and get help? These are things that allow modernization of things to the degree that people want. You know what I mean?
Yeah.
But I also think it's really cool that we're getting the satellite stuff because I'm seeing a huge, I don't know if you see on social media as I do, people care about that now, and they're like choosing airlines that only use
dude, that's so funny you said that.
SpaceX, Starlink.
Yeah, there was a guy the other day, he was like, I'll never not fly Delta now because I literally was FaceTiming my wife. The internet was so good. I was FaceTiming my wife and kids.
United, I think.
Or maybe
Delta doesn't use Starlink.
Okay, so then it was United.
It's United.
Whichever one is like United. Got it embedded into it. I used it too, and it was so fast and so good. I worked the whole way. I loved it, right? And when you think about those are to your, that's like a small thing, but extrapolate that across many different industries and many verticals that people are making buying decisions because of
on speed.
That makes all the difference.
Little whipped cream and cherry on top. We have freaking supersonic flight.
Yep.
NASA just perfected the landing gear system to be approved, FAA approved. So now we're not like 10 years or anything. We're like 5-ish years, I would say, until we have. They already did it. I don't know if a lot of people know. You used to be able to fly from L.A. to New York in 51 minutes.
That's crazy.
Can you imagine that?
Yeah, I mean, look at this. So NASA's supersonic flight efforts are centered on the X-59 quite supersonic technology aircraft, which successfully completed its first supersonic flight in June of this year, reaching Mach 1.1. Lockheed Martin leading the way in that. So, I mean, yeah, these are the things that, if you're paying attention, these are some...
Yeah, they get to Mach 1.5, 925 miles per hour.
Yeah, that's insane.
Oh, my gosh, dude.
So do you think because SpaceX has so much cash sitting around that they are also well positioned to just go and continue to swallow up market leaders in niche verticals that will, instead of us having to build this from the ground up, we just are so flush with cash that we're going to go and buy leaders in the verticals that we want to bolt on. I mean, what was that? That one company they just
on their IPO day announced
was it $6 billion on that.
Yeah, they announced a purchasing of a company the week they went public.
Yep.
I mean, they're no holds bar.
Yep. So you're obviously bullish on SpaceX long term.
Yes, long term.
Short term, we still expect more volatility.
Absolutely.
I think there's only 4.5% of the actual stock available right now.
Yeah,
somewhere around there. So once there's more unlocks, you're expecting there to be more sell-offs.
Oh yeah,
it'll figure out its bottom.
There's a lot of firms that just buy IPOs,
right,
to hold them and to get them at a really low cost. I mean, you have to remember people bought into this for values that would blow your mind. Dollars, and now they're sitting at 140, 130 right now, and just eating. To me, I still think there's volatility in the short term, less than 12 months. But I will say long term, I think it's going to be one of the biggest companies in the world, if not the biggest company in the world.
Yeah. Yeah, I mean, I'm not one to bet against Elon Musk.
No.
Dude thinks bigger and executes bigger than anybody on planet Earth thus far.
Thus far, and he's a pretty decent human. He makes mistakes like everybody, but he's a pretty decent guy. And his companies have done a lot for humanity as far as providing technology to move the ball forward. I mean, he has people from SpaceX. I can't remember. Is it Terra something? They just started this new company. All robotics construction. They have no humans. They literally show up to a work site and drop off a bunch of robots, and they build everything.
That's fucking cool.
24 hours a day,
yeah. See,
nonstop.
I don't know if you guys have been listening to the show the last few episodes, but we've been saying like robotics is an area that I just think it's going to be so fast.
They're producing them in Fremont. You know that, right?
Oh, really?
Tesla Tor is almost done tearing out its Fremont plant in California, and they're fully replacing it for 100% Android or whatever they're calling it, the robot they're making.
Yep.
That's it.
That's wild. That's crazy. So what do you guys think? Are you bullish on SpaceX? We'd love to hear your thoughts because I'm always curious to hear what other retail investors are thinking about and looking at when it comes to these types of stocks. Here's an interesting one that I wanted to get your take on was private credit defaults hit an all-time high. Mm-hmm. Yeah, which was funny because the other day, and I made a podcast on this a while ago because this was kind of the chatter in the
debt space. Trust me, I know a lot of dudes. They were like, "Oh, hey Ryan, big advisors, big asset managers that I know around the United States. We're talking. I know this one group has about $47 billion." Out of Texas, and I was talking. Oh, you're getting your clients
in private credit.
Yep, out of that because in my space, what they were doing is selling off like intermediate bonds, then kind of the not sexy stuff. Coupon rates are like 4.6 to 5.3. They're saying we can get these private credit rate, notes at like 7%. Clients getting way more yield.
Yep.
It still is. It's an agency, mortgage-backed security. We're good to go. I was like, I don't know, man. Private credits, everybody's getting into it. I don't know a lot about it. It's in real estate, which is not super hot. I don't know if those coupon rates are sustainable. Now, if you look at it, a lot of those funds are bleeding because people are getting out of them as fast as they can because the yields are
the redemptions are
tanking. So you get this. I got into this to get, I can deal with a little bit of volatility on the face amount because I'm getting paid more. Well, now it's like, now I'm getting paid 10 basis points more than an intermediate bond fund or bond coupon rate, and I'm taking twice the amount of risk. I'm taking high yield risk for the exact same yield I can get at investment grade. So it just doesn't make any sense. So I was. Don't ask me who's going to be president sometimes, and don't ask me on rate cuts. You know what I'm saying? But I was right on that too. I was like, that was not something I talked about. Just in my head, I was like, I just don't know if this makes sense.
Yeah.
Because we have like blank check companies and things like ARCC, Ares Capital Corp, 9% dividend. You can buy it's a stock, but they're just a blank check company. They just write massive checks and finance things. They're I think they call it a BDC, business development company.
Okay.
So they just spend money to develop companies to make money off of them. So you can get a crazy amount of yield from them. I mean, we have a like a high yield. Like, what are you pulling out of Imagos? 12?
10.
10? I think we're pulling 13.7.
Wow. But
the volatility is nuts. It has like a 0.91 beta to the S&P. It has a 91% of the beta or risk of the S&P 500, and it's an income fund.
Mm-hmm.
But it's all backed by lots of things like what you're doing, and then a diversification of REITs and all this other stuff, paying a lot, and then it grows as well.
Yeah.
So like, there's all sorts of stuff that exists out there. But the problem with that is, in my world, whenever you go really high payout,
mm-hmm.
you're essentially just, why not just buy a stock now and just say, forget the payout, I'll just make 20% on the stock.
Yeah, right.
And then just sell it. Sell it down to a 13%, return, and keep the 7. You know what I mean?
Yeah.
So to me, again, real estate is really good at doing what you're doing with much lower risk.
Yeah.
Because
right.
in the stock market, to get that type of yield is like,
you're taking high risk.
Yeah. You can get 5-6% with debt, but not like the debt you're talking about. You can't get first in line. You're going to go essentially into a risk pool with a bunch of other people, and the bank is going to take the other half or more.
Yeah, they'll be in first.
Correct.
So, because it was interesting the other day, I saw the Financial Times. Mind you, the narrative is private credit is risky. I mean, is it the next shoe to drop in the finance world? There was a lot of noise around it for months, and then it kind of went quiet a little bit. Then I saw this again today, where in the same day I saw the private credit defaults hit an all-time high, and then at the same time, as I'm reading through the Financial Times, I see Starwood's Distressed Opportunity Debt Fund raising $10.2 billion. So kind of funny where you've got on one side.
That one makes more sense than the other one. They're like, hey, we're gonna find the low-hanging fruit.
Well, because they know that there's distress and opportunity that is coming through the pipeline, right?
Starwood's one of the biggest REITs in the United States.
They're
a hospital, right?
What, Starwood?
Are they medical? Is that what they're
Starwood
managing?
Capital has been in hospitality.
Hospitality. I missed the hosp up.
Yeah. But at the same time, it does tell you that, I don't know, I always like to pay attention to where you see some of these, it's always the top 5% that usually ends up cleaning up the bottom 95% once the shoe drops, right? So there could be, both of those things could be true at once, where private credit is potentially showing some major cracks and you've got the biggest, player in the sandbox that is positioning to go up and restructure and resettle and scoop up a bunch of that opportunity as well, right?
Yep. Somebody would, if they don't, somebody will, and I don't think people get that.
So does this have any impact with, if it does unravel or does start to, the domino falls, does that bleed into other things that you see impacting investors in your world?
Not really. I think it would rock the high yield debt and non-investment grade debt world, and I think there'd be a little bit of a yield strike. For lack of a better term, people would be scared of
they'd go risk off in that area 100%. For sure.
Which is weird to say, like risk off in debt.
Yeah.
But they would probably go on yield strike. That's, I don't want high yield. I want something safe. I think it'd be a field day for munis. That would be what would happen. People would just fly to the safest version of debt, which in my opinion is like municipals or treasury bonds or things like that. You're going to have a lot of insurances backing those. But I also think, at the same time, when people go risk off, there is risk to having not enough risk. We always have to find that balance. And so I encourage investors. That's why we make a plan, and then we stick to the plan. There's no doubt that we sell and do risk off. It's like, okay, hey, lots of volatility. I don't need to hold my small cap and mid cap. I can hold my large cap, but I don't need to ride an extra 7 or 8% down because I want to hold a small company right now.
Yeah.
I'll cut my losses, wait for it to bottom out, and get back in.
Who are you watching this week in terms of earnings that you're expecting positive or negative
Let me make sure
reports on?
Let me make sure it's not next week. I was very excited about JP Morgan. That was the one I was mainly.
And what were you paying attention to there? Why are you excited?
We have a large position in them for our clients. I would say they're a core holding for us. We've been trading the Wall Street big investment bank managers, Goldman Sachs. We made a freaking killing on that. I think our entry point somewhere around the 400 to 500 range. It's trading over $1,000 a share now. That was the one I was most excited about. United Healthcare.
Mm-hmm. We've been talking about them for a while.
Yeah, Taiwan Semiconductor. That's going to be huge. General Electric, Netflix, Abbott. Those are the ones I just pulled my little note list. Those are the ones I'm looking at. I think most of those report on Thursday.
Okay.
Or Wednesday, either Wednesday after or Thursday before market. And those are the ones I'm most excited about. They're kind of like very, healthcare has been down. So United Healthcare and Abbott, I want to see what they're reporting. Are they still a dog, or are they going to start making money again? I think we might be surprised by United Healthcare. And then on top of that, Taiwan Semiconductor, with all the talk on chips, with all the talk in the semiconductor space, have they been a benefactor of that? I would say probably yes.
Is that still got some room to run on the semiconductor side? You've been hearing people kind of talk about it losing steam, or there being some rotation out of it.
I would say there was some rotation. I was profit taking. It ran like 70%, in a month.
Is it too late to get exposure to those companies?
No, not at all. I mean, you're not going to get. It's kind of like buying Apple in 2017 and then sitting in 2020 and being like, hey, look at how much money I've made on Apple, and being like, I wonder if it's too late. And if you would have bought Apple in 2020, you would have been eating right now.
Yeah.
Not as much as the people that bought in 2017, but still a good idea to buy under those circumstances. So to me, I think getting diversification to quality, as I always say, building a portfolio and figuring out how we can get a little bit of everything and kind of have the overweight in some of the best names, that's a great idea. You can't worry about when you get in. You just have to worry about, is it a good time to get in or not?
Yeah.
The stock, a famous Warren Buffett quote that I always say is, stock doesn't really care what price you buy it at. It's going to do what it's going to do. If you buy it 5 years ago and it's going to go down, it's going to go down. If you buy it 5 years ago today, if it's going to go up, it's going to go up. You just have to get in at the right time to have the right amount of momentum behind it. It needs to move the way you want it to move. So the price is less relevant sometimes than people think it is.
So we mentioned this a little bit ago. Affordability still seems to be the Achilles heel of the U.S. economy.
I would say the only
Achilles heel of the U.S. economy.
Yep.
So, do you follow Anthony Pompliano on X?
No.
This guy, he's always got some interesting takes if you want to pull him up. But he said this himself. He said, no matter how high the stock market goes, a significant portion of the population continues to feel they can't afford everyday items needed for a normal American life. You agree with that?
Agreed.
You do?
I even get a little pissed when I go to the grocery store and I'm getting fucking wrecked. Dude, I bought a 2-pound. Is it flank steak?
Dude,
flank
steaks are...
It was $48.
Oh.
I said, what the hell? $48 for choice.
Right.
Bro, I'm getting slapped on a choice flank steak for 50 bones. That's a lot of money.
So I was
buying those for like $23.
So that's what I'm saying, right? I think about you're in a position where you can afford to kind of eat that, right?
Yeah, of course I
Whereas
can. No pun intended.
the average...
It's expensive.
So my question is can an economy really be healthy when the basics feel out of reach or misaligned with their ability to afford and to live and to lead a healthy lifestyle.
No, but you have to remember, and this is something people always get twisted, so don't get it twisted. The economy is not the stock market.
Mm-hmm.
I don't know if that's rocking anybody's socks off right now, but the economy is not the stock market. So we can have a stock market with a bad economy. And I would say right now we have a really good stock market with a moderate economy. The Achilles heel that you were pointing to is affordability. It's too damn expensive to do anything. I can afford it. But does that mean that I'm happy? No. And when I go out and I shop at a premium grocer, so it's more expensive for things. I have to tell myself, like, don't buy the fucking 12-pack of soda for $14.99. I can go to Walmart and get it for $6.
Yeah, right.
Diet sodas only. And I'm like, if I go to the grocery store 4 times, it's a $100 trip almost every time. If you're buying a protein, so what happens is it makes people. This is where it sucks, because this is where my mind goes. What are people going to do? They're going to buy more processed or frozen foods. What is that going to do? That's going to make them unhealthy. What is that going to do? Increase healthcare costs. What is that going to do? Make people's insurance premiums high. It's a vicious cycle of one little thing having a ripple effect.
Yeah.
Aggressively across the economy. That's the economy. Okay? Where we transact business, where we play. That's not the stock market. Okay? The stock market's where we make money with our money. That's what the stock market is. We're investing in companies to make money or investing in debt to make money. That's it. Or gold or commodities, but you get what I'm saying. So I would say right now we have a moderate economy with cost being the thing that's too sticky for people and needs to get out. And we have a really good stock market.
Yeah.
So it's a great time to invest, but then people's discretionary income is low and they can't take advantage of it.
Right. Which is the challenge, right? So where does the opportunity hide in times like right now?
Typically right in front of your face.
People just have to find a way to get into stock market, get into asset ownership.
Yeah, assets. Quality assets. I don't want to tell somebody not to do real estate or not to do stocks. Or you should throw what you know. I'm a stock guy, so obviously I'm doing securities, insurance products, things like that. That's what you can do, a mix of that plus real estate. You could do it this way. You can do it this way. It works. You just have to find your mix and commit to it and get it going. That's ultimately what all successful investors have. You can't pick one. Like if you went to your conference of a lot of your real estate investors, even though you know that they're majority real estate, none of them are going to have the same makeup of their overall portfolio. They're going to have different weights and different ideas of what they want to do. That's the makeup for their financial plan that they have. They have built a plan around what they like and what they like to do. That doesn't mean they're not going to be successful because you two, he looks like a square on paper and you look like a circle.
Yeah.
You can still find your peg and fit into it.
You can't, it's dangerous to think that you have to do it the same way as somebody else is doing it, right?
Correct.
We've talked about this so many times. There's so many different ways to build wealth. And I also hear and see a lot of people too talking about feeling discouraged of doing something in investing if it doesn't feel significant enough when you're starting.
Yeah, that's the FOMO. And I talked to somebody the other day about this, just patience. It's hard with the gamification of everything and how big gambling has gotten. And I love doing a little bit of responsible gambling. There's nothing wrong with that. Love to throw down some cash
a
on
little
the
parlay, a little pony.
You
love your
pony
ponies,
time, baby. But it's responsible. It's not saying, well, this is my retirement assets or these are my investing assets that I'm trying to get my money to grow. You don't need to speculate so much on that. You have to just be patient and know that the crock pot mentality, like we say, is always just better than the microwave. Microwave has its day, no doubt.
Yep.
It had its day at my house this morning.
Yeah.
Had to get that frozen burrito that I made the other day heated back up. But the crock pot gives you a better product because it has time. Things get to work together. You get to the benefit of compounded interest is one of the things that makes investing in the stock market and real estate so sexy.
Yeah.
So
I just tell people, I mean, even if you're just starting out or you're not investing at the level that you want to be, something is better than nothing. That's just start there, right?
Yep.
I mean, even $100 over 40 years, that compounds.
Yeah.
I mean, it might feel and seem insignificant to you. Don't get FOMO. Don't compare yourself to what other people are doing. I think we all fall victim to that, but you really just have to be in the game and start somewhere. And especially in real estate, why I love real estate is, and you obviously can't do this in the stock market, but in real estate, like, we can find ways to collaborate and pool funds and structure joint ventures or partnerships or syndications. There's so many ways that you can still get some level of exposure. I mean, when I was first starting out, I was using OPM to buy house flips. I mean, when I bought my first hotel, I raised capital from other people and through my sweat equity and finding the deal and being the one that was doing all the work. There's all types of ways that you can bring value to something. And same thing in your world. I've just learned more by, one, investing and being in the game, but then just by being in proximity to the people that have the results that you want and are doing what you want to be doing and are getting results that you eventually want to get yourself. I put so many extra little tools. I mean, I ask you 100 questions a week on what do you think of this and that, but it makes me better by just being in it versus being on the sidelines and just, you know, in silence, like kind of suffering and being upset that I'm not doing it. Right?
I call that
like,
pocket watching.
Pocket watching, yeah. So
watching with your pockets. I'm not doing that because it's not a good time to get in. So they shouldn't have done that with their money. When you have a comment about what somebody else is doing with their money, especially when they're doing something good with their money, you're pocket watching.
Yeah, it's a good point.
Stop watching my pockets.
Well, Wall Street Journal just, and to this point, right, nearly half of American adults under 30 are living with a parent. I think, what was the other one that I saw in here? 1960 versus now, talking about home ownership. In 1960, more than half of 30-year-olds were both married and homeowners. Today, it's roughly 1 in 8. The share of married adults, 25 to 34, collapsed from 59% in 1990 to 39% by 2021. The typical first-time home buyer is now 38 years old, up from 33 in 2020. A spouse and a deed used to define the average 30-year-old. Now they are a shrinking minority. So I think for me, again, you can't decide and tell people what they should be doing, but my encouragement is for more people to just get in the game.
Yeah. You're
gonna lose, right? You're gonna take your licks, but those also are the things that just sharpen your toolkit. And I just hate to see so many people reading these headlines and just going, I can't do anything about it.
Yeah, and the thing is, I was just looking at this one guy I've had. He's been putting $350 in this account for like 5 years, $350 a month, and it's got $49,000 in it.
$350 a month feels insignificant when you're starting. 5 years later, when you look up and you got 40 racks in there, you're like,
told me he's
okay.
Like, I just don't even look at it. It's $350 a month goes into that brokerage account, and it's nothing sexy. It's a nice little thing we built for him, but he's averaging over 14% for his rate of return. I don't know what else you want to do, man. That's cranking. And it's boom, boom, boom. And in the future, that $350, because I know his age, he's in his early 30s. If he kept doing that, that would be a multi-million-dollar account. And he would put in just $350 a month.
Which is wild, right? Because when you think about if I were to go through and audit most people's spending, I mean, Caleb Hammer does this on his show, which is awesome. I love how he fucking just rips through people's finances. And I mean, the amount of waste in terms of spending that people spend on shit that adds zero value to their life, does not bring more benefit, add a skill, create a better, quality of living. And I'm not, I'm talking about like wasteful spending, right?
Mm-hmm.
Like you could find ways of justifying, I do this because it's for my wellness or my happiness or this or that. Like there's, I can get down with that to a certain extent.
Yes.
But then there is like just categories of egregious, low or no value spending that the average American does that I guarantee you would equate up to, if not more, than $350 a month. And if they just found ways of being more financially responsible, with some of their spending. And this is where I encourage people. Like I have all my bank accounts locked up, lined up to. Have you heard of Tiller?
Mm-hmm.
Yeah. So super simple. It's some AI, spreadsheet kind of aggregator of all your expenses and this and that. But I get a daily email of everything I spend. And just through that awareness of staying in proximity and in relationship to my finances, every month, or really every week, I'm like, I ain't fucking spending on that again. Or, hey, Marie, we ain't spending on that again. Or, I'm going to cut that subscription next month, right? Like, it's just certain ways about little tiny areas of diligence when it comes to your wealth building can make all the difference when you think about the compound effect over 10, 20, 30 years.
Yes. Sorry, I was watching the screen. I thought there was something about to pop up. Yes.
Tom was checking it out.
If you do little bitty kind of hacks, they have a really big. That's the compounding effect I was saying over time. Just your money works really hard for you. Your account pays you. I remember when he was setting it up, his like dividend rate when he originally started was like $27 a year, and now he's getting like $1,600 a year. That's extra money going into his account that's going to work for him. It's little steps, but they pay off, and he's right around the corner from getting to 100K, and that's going to really take off.
Well, I mean, I remember when I was just starting my stock stuff with you, and you're like, once you get to 100, it'll get exciting because then you start.
That was only a couple years ago.
Yeah, now it's been just climbing, which is fun. So, I think that is just something to be mindful of because it's easy for little things to creep in on subscriptions or this or that.
And then say I can't afford things, but it's just like I don't want it. I have no immediate return on this, so I can't do it because I'm not familiar, and I just want to have something that has immediate hit.
Yeah,
invest in yourself. Before
we shift over to the crypto side real fast, you can pull this up on the screen too. I just thought this was interesting, right? I mean, this kind of goes back to what we were talking about. I mean, look at ground beef, dude, 80% up.
Yeah.
Since. 2019?
And I eat a ton of ground beef.
I mean, you got new cars are up 22%, used cars up 29%, groceries up 33%, shelter up 35%, health insurance is stupid, 38%, restaurants 40%, transportation, electricity 45%, gas up almost 50%. So, I mean, these are things that we're not seeing people's wage growth stay in line with this.
Not at all.
And then you tack in
that
you look at all the other hidden taxes that we have in terms of sales tax and property tax. And I mean, people are it's very interesting when you really pay attention and your eyes open up a little bit to this, which is why you have to be that much more diligent with how you manage and oversee your money. I mean, it's like your life depends on it. It sounds fucking ridiculous and over the top and cliched. But to get wealthy in today's world, it's easier than ever, but it's also harder than ever if you aren't building the right skills, surrounding yourself with the right people, and utilizing the tools that are at your disposal, which most people aren't.
Correct. And a lot of people also try to be the expert in areas that they're not and don't want to pay to play. And that, you don't work for free, I don't work for free, but we provide a lot of value to people that work with us more so most of the time than they can do themselves. So that's also something I would encourage, not just as an advertisement, obviously, for myself or for Matt, but to just say you don't have to be worried about paying people to provide you value. That's what wealthy people do. If you think entrepreneurs are the wealthiest people in the world manage their own investment accounts, you are out of your mind. They have teams that do it. Same with their real estate.
Yeah.
They have other stuff to do. Their time's more valuable.
Yep.
So delegating that time and then taking your time back is very important, and that's worth the money.
Yeah, for sure. All right, so we got a little closeout on crypto. So we've got
Bitcoin's pumping.
Yeah, it is pumping. I mean,
Ethereum's
as
up.
of today, all of them I think are nice and juicy after the CPI print. So what did we see today? We saw we're slowly climbing out of on the fear and greed index, extreme fear, going from extreme to just regular fear, and we're kind of going in towards that moderate position. We do see, let's see what we got here on, I think today Bitcoin's up 3 or 4%, 4%. We've got Ethereum up almost 7% today. So things are, again, if we can see a little bit more confidence and clarity around liquidity and rates, I think that's obviously going to benefit the crypto market here. People get a little bit more risk on because crypto has been depressed, and kind of in the dumps for some time. So I think
all rate sensitive areas have been.
Yeah.
So it's not just crypto. They're a little more rate sensitive because people like to leverage with crypto. And that's also why it swings so much.
Yep.
But that's a rate sensitive area. When rates go down, I would expect crypto to move in inverse relation.
We saw on the Clarity Act bill text coming in the next few days. Senator Loomis says after 10 months of daily work, the bill is ready to be introduced, focused on fighting illicit finance, adding consumer protections, and keeping crypto markets onshore in the U.S. I mean, I've been saying this for some time, and you've been saying this for years. Once regulation, rules, guardrails, protections really kind of get enforced in the crypto space,
mass adoption,
we'll see a lot more adoption.
Oh, yeah.
We've even been seeing some interesting stuff go on in the tokenization space. Goldman Sachs just did some really big stuff.
Robinhood.
Robinhood has been they're doing some real big stuff on the RWA, real world assets. Let me see if I can find this actually, because I read it last night and I thought it was really interesting. This was from the guy who is the founder of Airbnb. Let me see if I can find this really fast, because this was very interesting. But basically, he was just talking about how real world assets. I'm just going to pull it up on my X real quick. The way that they're going to be tokenized and what's kind of been getting worked on is definitely going to be here kind of before we know it. And his thread that he did was really good. Here, while I'm pulling that up, where the hell did that go? Because it was a good one.
I hate when I lose a link.
I know. I've been saving so many for you guys. What did I do with that? Airbnb guy. Do you remember what his name is, the founder of Airbnb? Founder of Airbnb. Let's see. Brian Chesky. There we go. I'm going to find his thread really quick because I think it's interesting from a real estate perspective, but I think just in general of how kind of mass adoption of tokenization is going to, it seems so awkward and foreign and kind of clunky right now. So he did this post yesterday. Where is it? Okay, so... Man, this dude posts a lot.
You're getting smacked in it.
Mm-hmm. Maybe he took it down? Why? Because I thought I saved it. It was in my... Yeah, all right, well... Sorry, guys. I'll see if I can find that, and we'll save it for next episode. That being said, what we did see in Kevin Warsh, his chat today, he said the Fed should stay out of the bailout business, crypto included. So did you take anything out of that comment in terms of like whether that's stock market bailouts, banking bailouts, private credit?
That's a nod to just anything, but I think it's banking, broadly. If you make a mistake, you're going to pay for it.
Yeah.
We'll let you go. We'll let you be liquidated, and you'll be bought up by investors, and the Fed's not going to go and save you. So no more risking it on the backs of U.S. taxpayers, essentially.
Yep. All right. Well, I do think here's one more. So I always love finding these little economic collapse videos for you because this guy
Where's my
has.
silver guy, man? I miss that old dude with the silver in his RV. Oh, God. I can already tell this is going to be bad.
So Colonel Douglas McGregor warns of pending economic collapse when the bond rate hits 5%. If this video will load.
What is this even
rate,
on?
interest rate hits 5%, we're through. We cannot service the debt. We cannot borrow any longer. The destruction of credit, which is inevitable at that point, is going to bring everybody in the West down. And that's where we're headed right now. We're going to hit that 5%. It's going to break, and then we're going to be in free fall. And that's going to bring everything to a screeching halt. In the United States, it's all the people that are invested in pension funds, which we're borrowing against at a very high rate. And those people are going to lose everything. That's my generation. These are the so-called boomers that have been paying into these things for years. All of this is going to happen. That is finally going to change everything.
So does he have any, I mean, with where are...
I don't even know what he just said. There was a lot of word salad there. I mean, first of all, I would love to... I need to work on my cheeks because that dude's cheeks were glazed.
He was...
That was incredible. No, I mean, I don't even know what he just said. He just said a bunch of things like, pension funds are going to collapse. I just don't know. I don't know who that guy is. I don't even know if that guy knows what day it is. He does not look like he's somebody I would rely on for financial data. I don't know if I do either in this shirt, but I'm telling you what. I think that there's a lot of people that do that type of talking, and that's typically when they're trying to sell a narrative or sell a product. I don't know. I don't know what that was. But a lot of anytime fear is the main ingredient, I'm typically avoidant of it because that's an easy sell, and that's why people should be buyer beware.
Yeah. All right. Wrapping up on some AI. What are your thoughts around AI, kind of just the overall AI data center narrative, CapEx, AI stocks? How are we looking and shaping up in AI to kind of close out this year?
A little choppy, but still very early. I think things are still looking good, and I am hopeful for a stronger push in that sector by year end, especially with Christmas and stuff coming up. We're going to see a lot of probably people buying more toys and items that have AI integrated in them at the hardware level. So we'll be very interested to see.
Yeah, Bezos had an interesting question that he did in an interview, and it was kind of like basically talking about a lot of things that AI won't change and the overall kind of narrative around in a world moving this fast, the people who build their wealth in arenas that AI isn't going to eliminate or is actually going to amplify are going to be the real big winners.
Yes.
And I saw this girl's thread, which was actually kind of cool. You can pull it up on the screen, Tone. I don't know who she is, actually. Amanda Orson, founder of Galleon AI Real Estate Investing FinTech. She puts out some interesting stuff, but the faster technology moves, the more I think about Bezos' question. What won't change in the next 10 years? So you guys can take it for what it's worth. But I think there's some interesting sectors in here that, or asset classes in here that, depending on your skill set, your access to resources, information, however you want to apply this in your, investing thesis or career, there could be some alpha in here. So things that she's been writing down over time is kind of a cool list. So humans will always need shelter, food, and energy, and healthcare, which obviously big part of that are asset classes and commodities that the stock market can give you a ton of exposure to. The physical world will move more slowly than the digital one. Every increase in technological capability, especially AI, will require more energy. People and businesses will continue to need access to capital. So some of the themes here that we've been kind of talking about: real estate, stocks, private credit. Capital will continue to seek returns that exceed inflation. Underwriting methods evolve, but demand for credit loans is persistent. Trust remains scarce and becomes increasingly valuable as content code and fraud become cheaper. Verified identities and reputation becomes more important as information becomes abundant and synthetic. Long-term wealth creation and Dynastic, multi-generational thinking predate modern technology and will persist. Coordination and transaction costs never fully disappear. Market friction will continue to justify the existence of firms and intermediaries. People will continue to compete for status. Consumers will pay a premium for products and services that confer status. Time remains fixed at 24 hours per day, but attention is a finite resource and an enduring constraint. Products that credibly save time or enable delegation have a perpetual market. Inaccessible proprietary data will be a persistent moat. The more inaccessible and difficult to aggregate, the deeper the moat. People want accountability, recourse, and clearly identifiable responsibility when things go wrong. Regulation consistently lags technological innovation. Compliance requirements, licensing, and regulatory moats persist even when machines can perform the underlying task. Local knowledge remains valuable and difficult to replicate. Heterogeneous markets, like real estate, continue to reward people with deep contextual understanding, and incumbent organizations tend to underinvest in disrupting their own businesses, which always creates opportunities for challengers. So she just said Bezos's insight on what wouldn't change in 10 years was customers will always want lower prices and faster delivery. It's boring but true, but I think that's the point. So just thought that was kind of interesting, right? These are just maybe some trends, some things to think about, you know. I mean, there was a lot of stuff culturally, right? Like there was a lot of stuff of mentions in social media, personal brands, people connecting with people and businesses that they know, like, and trust. Mm-hmm. You've got, you know, the idea that a lot of, you know, technology is going to enhance a lot of things, but there's still always going to be that analog element that people are always going to want access and connection to, and the people who do it well or great in those areas are going to absolutely crush it and build moats around their business. Was there anything that stuck out to you?
Mainly the part about delegating, because I just mentioned that at the beginning of this episode. So that was just interesting that it also said, hey, people that learn how to delegate and use their time more wisely probably will be more successful. Yeah, absolutely.
All right, so let's finish off with a couple mindset pieces that I loved. Well, Ty Lopez, he's always a little controversial, but here's 3 things that make people poor.
He's
sensitive.
In a Ponzi scheme
lawsuit right now.
Yeah,
and he's still pumping out content. He don't give a fuck.
Yeah. 3 things make people poor: sensitive, proud, stubborn. You're allowed to maybe have 1. Some people have 2. If you have 3, give up on money. 3 things make...
Do you agree with that? Proud, sensitive. What was the last one?
Stubborn. I guess. I don't know. I don't really like him, so I don't really. When he talks, all I can see is him talking about himself. That's all I see. Whenever he talks, he's always talking like, "This is what you want to avoid," and I'm like, I feel like you're just talking about yourself. I feel like he's proud.
He's very proud,
sensitive, and stubborn because he keeps doing shit that doesn't work and thinks he's fucking the next best thing. So I don't know.
All right, 3 levels of wealth. This was another one. I'm curious to get your thoughts and take on. I know we got to get you out of here. So 3 levels of wealth. 1, you can pay your bills. 2, you can order anything on the menu without checking the price. And 3, you can travel wherever you want without stressing the budget.
Those all sound great. I think that sounds like a pretty...
Those are pretty good accurate tiers though, right?
Yeah, attainable lifestyle too.
Because once you can like pretty much travel anywhere you want, whenever you want, at any point in time...
There's no budget,
and there's no budget, right?
Discretionary,
like, and obviously you've unlocked the other 2 tiers. Like,
that sounds great to me.
What additional things? I mean, at that point, it's like, what else do you really need?
You're splitting hairs, I think.
Yeah, I think so. Yeah. All right, and then the last one I loved was Terry Crews said this. Another Ty Lopez quote, but I like Terry Crews. He's got a great brand.
Be the only. Be the only. There's only one Terry Crews. You never be like me. And I'll never be like them.
You trying to build your personal brand? Memorize, tattoo this saying to your forehead from Terry Crews. Do not try to be the best, be the only. It's called RIN score, value, rarity, inimitability, non-substitution. My personal brand is an asset that's made me money every single day since I launched in 2000. Never failed to wake up to money. Why? Because I don't have to worry about being the best. I just have to be the only. The people who like me, and you don't even need many. You need 1,000 true fans to 10,000 true fans to make $1 to $10 million a year from your personal brand with at least 20 to 40% net profit margin in your pocket. Don't try to be the best in personal brand. Just be the only guy. For me, I'm the only guy who has a phone.
So anyways, he goes on, but I just like that thing. I think a lot of people are trying to be other people that they're not.
Mm-hmm.
Don't try and be better than the next person. Just be the only person that you
Don't
are.
be an imposter.
Just be yourself. Be great at it. Give people a window and a bridge to connect with you. And I thought that was a good way to kind of end the show today. So as always, we love and appreciate you guys tuning in. For our live viewers, thank you. We see you. And don't forget to connect with Ryan and his amazing team. If you guys want to know what's in our basket, you want to explore what's in your basket of your portfolio, your fees, connect with Ryan and his team. Text the word XRAY to 844-447-1555. If you're a passive investor, you want exposure to real estate, and our Imagos Income Fund, you can text the word income to 844-447-1555. Partner with us in being the bank and doing private credit. As scary as that may seem for some people, we're obviously doing very risk mitigated investments in first position on assets that we know and can own and operate if anything were to go wrong. So if you want to know more about that, text the word income, 844-447-1555. As always, we appreciate you guys. We'll be live back again next Tuesday, 2 p.m. PST, 5 p.m. EST. As always, keep investing in yourself and your wealth on your march to $1 million and beyond. Cheers.
Cheers, y'all.